If you think credit cards are dangerous, expensive, or irrelevant to anyone who's not poor, you're not alone. But here's the truth. Believing these myths is costing you a lot of money. From fraud protection to cashback to some incredible travel perks, credit cards offer a ton of benefits if you use them the right way. So in this video, I'm busting 7 of the biggest credit card myths and showing you how to make money from your cards instead of losing it. So let's start with myth number 1, which is that debit cards are just as good as credit cards. Some people think using a debit card is the responsible choice because it keeps them from falling into credit card debt. They think that credit cards aren't worth the risk. And if you struggle with overspending, I get why you'd want to avoid credit cards. But the idea that debit cards are just as good as credit cards, well, that's a myth that's costing you a lot of money. Let's start with fraud protection. If your debit card gets hacked and someone drains your bank account, that money is gone instantly. If you're lucky, your bank will be able to get you that money back, but it could take weeks or months. And in the meantime, your rent, bills, and groceries all need to be paid. But with a credit card, you're spending the bank's money first. And if someone makes fraudulent charges on your card, then you can dispute them immediately and your cash never gets touched. There are tons of horror stories of people who have had their bank accounts drained and have lost tens of thousands of dollars in an instant with no recourse for getting it back. But with a credit card, you're safe. And that's a big deal. Then there's the rewards. When you spend $1,000 on a debit card, you get exactly $1,000 worth of goods and services. But with a credit card, you can earn anywhere from $10 to $100 or more in cashback or rewards on that same $1,000 of spending. And over the course of a year, that adds up to hundreds or thousands of dollars just for using a credit card instead of a debit card. And then there's the purchase protection and extended warranties. Most credit cards automatically extend the warranty on things you buy, like electronics, by something like an extra year. So if you buy a new $2,000 MacBook and it breaks after Apple's warranty expires, your credit card could save you from paying out of pocket for repairs. No debit card anywhere offers that level of protection. So the reality is, if you're using a debit card or plain old cash for your purchases, you're leaving a ton of protection and free money on the table. Okay, myth number 2. Many people believe that asking for a credit limit increase makes them look desperate or risky to lenders. They think that if they increase their credit limit, the bank will think they're in financial trouble. But that's just not how it works. And to be honest, the truth is kind of the opposite of that. Let me explain. Your credit score has 5 key components to it. And the second largest component, which accounts for 30% of your credit score, is your credit utilization, which is basically how much of the credit available to you you're actually using. So if you have a $10,000 credit limit and you use all $10,000, that's a 100% utilization. But that's too high. Banks like to see a utilization of under 30% because the more credit you use as a percentage of your total available credit, the riskier you become in their eyes. And the riskier you become, the lower your credit score will be. So if your limit is $5,000 a month, don't use more than $1,500. And if it's $10,000 a month, then don't use more than $3,000. So what this means is that increasing your credit limit actually helps your credit score, not hurts it, because it lowers your utilization ratio. But here's a pro tip for you. If your credit card provider won't increase your credit limit for you and you need to go above the 30% threshold, you can still be strategic in how you manage your spending once you understand how your credit score works. Basically, on the date your statement cycle closes each month, your bank will tell the credit bureaus how much of your spending you're utilizing. So if your utilization is high on that date, the credit bureaus will see it and your credit score might drop because it's a red flag to them if your utilization is so high. But if your utilization isn't high on that specific date, then they won't see it and your score won't drop. So here's what you do. If you need to go over 30% utilization, just make sure that you're back under 30% by your statement close date. That means you'll need to pay off some or all of your statement before your due date because your statement close date and your due date are not the same. But of course, if you can avoid all that just by increasing your credit limit, that's even better. And so I talk about climbing the credit card ladder in another video, and the whole idea there is that you want to get your first card and then upgrade to a better card and then upgrade to an even better card and on. And one of the hidden benefits of climbing that ladder is that you'll increase your credit limit at the same time, which will increase your credit score, which makes you eligible for even better cards. So it's like an upward flywheel that just makes things better and better for you. So I'll link to that video up here if you want to learn how to move up super quickly like that. But whether you do or not, it's definitely a good idea to increase your credit limit whenever you get the chance. All right, moving on to myth number 3. There's this old school mindset that if you use a credit card, it means that you're broke, irresponsible, or living beyond your means. But that's totally backward. And frankly, it's been backward for decades because the truth is the wealthiest people in the world use credit cards strategically and they use them all the time. They don't use them because they need the money. They use them because they want to take advantage of all the perks and layers of protection that come with them. Think of it like this: if you're going to spend $1,500 a month, why wouldn't you spend that money on a card that gives you 2% cash back? That's $30 back every month, or $360 a year for doing absolutely nothing. Or if you love to travel, you can probably get double that amount in travel rewards on the exact same spending. That's $720 worth of travel rewards, which, depending on which points you're earning, could get you a round-trip flight to Europe. And then there are all the perks that come with credit cards. With the right card, you can get priority boarding on flights, free airport lounge access, annual travel and dining credits, and a ton of insurance coverage, none of which you get without the card. So if you're still of the mindset that credit cards are for people who need extra money to make it through the month, you're throwing all those perks away too. So using a credit card isn't about being broke, it's about being smart. The key is to use it responsibly, but if you pay your balance in full every month, you'll get all these benefits without paying a penny in interest. But even if you're on board with having a credit card, many people draw the line at free cards that don't have annual fees. And that's what myth number 4 is all about. They see cards with annual fees of $100 or $250 and they think that's a scam. I'm not paying just to have a credit card. But here's the thing, a lot of credit cards that charge annual fees will give you way more value than what you pay in fees. I'm not going to get into specific cards here, though I do break this down in another video, which I'll link to up here, but that just makes intuitive sense. No one would pay $250 a year for a card if they weren't getting at least $250 a year of value from it. And in reality, cards that charge $250 a year will generally deliver double or triple that amount back. So you're actually saving hundreds of dollars a year by having the card. Now, to be clear, not every high fee card is worth it, and different cards are better for different people. If you never travel, then getting a travel card wouldn't make much sense for you, but if you travel a lot, then you absolutely should. So what I'm really saying here is that for the right person, paying an annual fee, and sometimes a very high annual fee, is actually a really smart move. The key is making sure that the fee you pay is outweighed by whatever you get back in return. Because if that's the case, then the fee isn't a fee, it's an investment. So if you want to see exactly which cards give you the best bang for your buck, I walk you through all the most valuable cards in this video up here. Now, a lot of people think that if they stop using a credit card, they should close that account to clean up their credit history and move forward on a clean slate. And that sounds logical because fewer accounts should mean a simpler credit profile, right? Well, that's not actually the case, and closing a credit card can actually hurt your credit score in 2 major ways. The first way is through your credit history length. One of the biggest factors in your credit score is the average age of your credit accounts, and the longer you've had credit available to you, the more stable and responsible you appear to lenders. So if you close your oldest credit card, you could be shortening your credit history significantly, which can lower your score. So let's think of an example. Let's say you have 3 credit cards, a 3-year-old card, a 5-year-old card, and a 10-year-old card. The average credit history length of these 3 cards is 6 years, but if you were to close the 10-year-old card, then the average credit history length drops down to just 4 years. And that could cause a noticeable drop in your credit score, which is something you want to avoid. But the second reason closing an old credit card can hurt you, we already touched on, and that's your credit utilization ratio. Because when you close a credit card, you reduce your total available credit, which means your credit utilization ratio, or the percentage of available credit that you're actually using, goes up, which can also hurt your score. For example, let's say that on those same 3 cards, you have a total credit limit of $15,000, $5,000 on each card, and you normally spend $4,500 a month between the 3 cards, which puts you right at a 30% utilization ratio. But if you close one of those cards, then your total available credit drops down to $10,000, and now your $4,500 of spending puts you at a 45% utilization ratio, which lenders are going to see as overly risky. So unless you're paying an annual fee on the old card you're considering closing, you should keep it open, even if you rarely use it, because having older cards that add to your total available credit and lengthen your credit history help keep your credit score high. So myth number 6 is that rewards cards aren't worth it because they charge higher interest rates than cards that don't offer rewards. And if you're someone who carries a balance month to month, that's a valid concern because high interest can quickly wipe out any rewards you earn. But here's the reality. If you're using a credit card correctly, you should never be paying interest in the first place. Because rewards credit cards are designed for people who pay off their balance in full every month. And if you do that, then the interest rate is irrelevant because you'll never pay it. Instead, you'll be stacking those rewards completely free. So I guess I should mention that if you're planning to carry a balance on your credit card, then you should drop everything else and figure out a way to stop doing that. Because for you, focusing on rewards and cashback is like picking up pennies in front of a steamroller, because what you should really be doing is eliminating that balance immediately. But this video is for the majority of us who don't carry a balance on our credit card cards, which means we aren't paying interest. And whether the interest rate is 10% or 10,000%, it won't matter to you if you pay off your balance in full every month. And I hear this last myth all the time, which is that the hard inquiry that comes from applying for a new credit card will destroy your credit score. And while it's true that each new credit application does cause a small dip, usually around 5 points, that dip is temporary, and it's really not a big deal unless you're applying for a bunch of cards at once. Because what really matters is how a new card impacts your overall credit profile. Because in most cases, opening a new credit card will help your score in the long run because it increases your total available credit, which lowers your credit utilization ratio. The only time applying for a credit card can be a bad idea is if you're about to apply for a mortgage or a car loan immediately after. Lenders don't like to see multiple hard inquiries right before a big loan application, so if you're planning on making a major purchase like that, it's best to hold off on new credit card applications for a few months beforehand. But outside of that, opening new credit cards strategically is a smart move, especially if you're doing it to maximize rewards and increase your available credit. People like me who play the travel hacking game open multiple credit cards a year, and we earn thousands of dollars in free flights and hotel stays while still maintaining excellent credit scores. So don't let the fear of a minor dip keep you from getting the right credit card that will help you achieve your long-term goals. As long as you manage your credit responsibly, the benefits of a new card almost always outweigh the temporary hit that you get from a hard inquiry. So now you know that credit cards aren't just for broke people, they don't ruin your credit score, and avoiding their annual fees isn't always the smartest move. But there's something else that makes an even bigger difference when it comes to getting the most value out of your credit cards, and that's choosing the right card. Because not all cards are created equal, and picking the wrong card means leaving thousands of dollars on the table. So to learn which cards give you 2 to 10 times more value than all the rest, watch this video next.